Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to hedge fund managers, family offices, sophisticated investors on a subscription basis. Just so everybody knows, this call is being recorded. If you're not comfortable with that, please feel free to disconnect now. Anybody with questions on the call, please use the chat function. You can chat with Steffi and she'll pass on questions. Thanks, Steffi. Today, we are very excited to welcome Peter Doyle and Chris Bell from Horizon Kinetics. Horizon Kinetics is a research firm and asset manager. They have approximately $5 billion of assets under management. Peter Doyle is a managing director and president of Kinetics Mutual Funds. He is a co-founder of the firm and a senior manager of the research team and member of the investment committee and the board. Chris Bell is the national sales manager. He joined the firm in 2001 and is responsible for national wholesaling team that primarily focuses on the distribution of the Kinetics mutual funds. The reason that we are looking forward to speaking with Chris and Peter today is because they and the firm were early investors in Bitcoin. They've done phenomenally well in the space. They have a huge amount of exposure and sophistication in the area. And right now, given the amount of printing the Federal Reserve is engaging in, people are understandably concerned about inflation and interested in hard assets. Peter and Chris, really excited to have you guys here. Looking forward to hearing what you have to say.
Thank you very much. I'm just going to tell everyone that we will have a few slides, very limited, just to break up the monotony, but the majority of the call will be directed or will be handled by Peter. So Peter, whenever you're ready.
Okay.
Go ahead.
Go ahead, Gary.
Yeah, so I'm just going to get you started, but we really want to highlight your knowledge here. Just as a starting point, how should we think about valuing hard assets like gold and Bitcoin? Do you have a way that you set a price target? Do you ever have a sell price, or do you just want to own it forever?
So for the bulk of my career and for the bulk of our career at Horizon Kinetics, we never really owned gold outright, or the mining companies in particular. We did own some of the royalty companies for a time. And there's no conventional way of valuing gold or Bitcoin. There's no cash flow. There's no future expectation of cash flow. You don't discount it back to the present value. You put some multiple on that. So gold tends to do well when you have the expectation of rising inflation. It tends to do well when the currency that you're measuring it in on a relative basis is in decline. And it does well if you have negative real interest rates. And that scenario seemed like it was shaping up for us. So we became more involved in looking at gold opportunities, principally through royalty companies, where a royalty company merely buys a royalty interest in a gold mine. It doesn't take on the operational risk. And any of the cash flow that it typically gets, it can use to either make more investments or to buy back their shares or pay dividends. And if you looked at the returns of the royalty companies that are available, you would see that they far, far outperform the mining companies themselves. And they just have wonderful operational characteristics. Bitcoin is very similar to that. There's no cash flow for Bitcoin, right? But in my opinion, there's asymmetric return opportunity in the sense that if you believe that the world is going to continue to debase their currencies and you want to store value, this potentially could become the next global store of value. And if you say it's ultimately going to have a market capitalization comparable to gold because it's going to be viewed as digital gold, you're talking about moving from a market capitalization today of Bitcoin of $200 billion to a market capitalization of close to $11 trillion. And if you think it's going to have a market capitalization of all the nominal stores of value out there, T-bills, cash, et cetera, we're talking about trillions upon trillions of dollars. So in my opinion, a single Bitcoin has tremendous upside potential. And that was really why I became interested in it almost immediately upon hearing it.
Fascinating. So Peter, you just hit on something that I wanted to talk about, where you're talking about Bitcoin as a global store of value. The other side of that are concerns about unfriendly regulation, and governments all over the world are kind of arming up to try to regulate it. I mean, I understand why they'd want to do it. Bitcoin is a legitimate threat to central banks all over the world. It's a threat to people who want to inflate the currency out. What are your concerns? How do you get over issues regarding unfriendly regulation?
Sure. So you know, the best answer to that is the sizing of the position, right? And there's unknowable unknowables. And there has been examples where countries have outlawed Bitcoin, but it's mostly more dictatorships and countries that are basically led by authoritarian governments. Most of the countries around the world are actually embracing it. And if you thought about it, if I was responsible for running a country, I would say, well, here's an asset. If this asset inflates into something big, I'm going to be able to tax it. So if I buy Bitcoin at $400 and I sell it for $10,000, I'm responsible for reporting that as a gain, and I pay taxes on it. So if I was a taxing entity or country, I would want that potential revenue. So I don't personally believe that's a tremendous risk. And then you would have to have all of the countries around the world outlawing it at the same time. So how does, you know, if let's say the United States decided to outlaw it, I could trade it in Japan, I could do it, go somewhere else and do it. So my perception of that is actually a fairly low risk.
Peter, is Bitcoin something that you can move across international lines? You can own it basically anywhere?
And you can take it anywhere as long as you have access to the internet. It's yours to take wherever you want. So you can flee the country in a moment's notice, and it's yours to reach wherever you are as long as you have access to the internet.
Let me ask you the same question about gold, because gold has been appropriated by the U.S. government in the past. There was a point where the government made it illegal to hold gold. Do you think anything like that will happen again?
So the reason for that, we're talking about going back now to the 1930s. I think it was early 1933. Franklin Roosevelt signed an executive order saying that you had to hand in your gold. And the reason for that was the dollar at that time was backed by gold. And the Federal Reserve was running out of basically gold to issue more currency, paper currency. So the government said, we need to collect this gold. And they're trying to get out of the Depression. And once they did that, they paid $20.60 some odd cents for the gold that they were buying in. They immediately moved the price of gold up to 35 and allowed them to print more dollars to help them get out of the Depression. I don't see that as necessarily a real threat happen again. We're no longer pegged to the gold standard, and gold has coexisted since the 1970s as basically a free floating commodity asset along with the dollar. So I don't think that's a real concern any longer.
Gary, I would like to add that Peter mentioned that you could go and sell it potentially in Japan or someplace like that. It is actually legal tender in Japan and Australia. So you can literally take your Bitcoin and pay your taxes with it. So beyond that, it's actually legal to pay your state taxes in a number of U.S. states now. So it's becoming more ubiquitous.
Chris, that's a really interesting point. Given that Peter was just talking about how jurisdictions would want to tax it, and given that there is a certain amount of anonymity in holding Bitcoin, and that, like you said, it can be moved into different places, is the reporting of the tax implications, does the taxpayer have total control over that, or is there any way it can be audited?
Well, I don't think Peter's ever sold a Bitcoin, but I have sold a couple, and I had to pay taxes, and I reported it, and there was no reporting from the places that I sold it. I owned some of it in a private fund, and there was a K1 that showed the gain, but the private ones that I held on this little tiny stick right here, I had to report those myself, and so I was in control of the reporting.
Got you.
So Gary, let me just add in on that. So if you go on a typical exchange, you go on Coinbase or Gemini or something like that, and you buy a Bitcoin, and then it appreciates, and you choose not to report it, you become a tax cheat. And most people are probably not going to do that. So maybe the government right now isn't going to be able to track you down, but if they are, you're gonna be in trouble. And most of the exchanges or wallets that you can buy it in, if you're doing it online, you have to register, you have to provide them with the Social Security. So they're following. It's only semi-anonymous. It's not completely anonymous.
Yeah, there's a pretty substantial KYC format that you have to go through in just about any scenario where you'd buy it.
Okay, great. So in terms of how you'd want to have this exposure, both for Bitcoin and gold, what do you think is the best way to hold it? And gold in particular, there are people who say you should have physical gold in your house, physical gold in a bank account, physical gold in maybe an offshore vault, virtual ETF, derivative exposure. I mean, there are all kinds of ways to do this. What do you think is the best way to go about it?
So if you believe the United States is going to be politically secure, the best way by far is owning the royalty companies that are available for trading. So Franco-Nevada, Wheaton Precious Metals, Royal Gold, Osisko Gold, their business characteristics, their operational level leverage is just off the charts. And if you looked at the returns, I'll just give an example, like per sales per employee, I think Franco-Nevada might be something like close to $20 million per employee. Goldman Sachs is maybe
that's slide number 6, Stephanie.
Go ahead, Peter. You can keep talking right over the slide.
So I didn't even realize it was on the slide. But so anyway, it's just in terms of profitability for the royalty companies, you take the best monopolistic company, Microsoft in its heyday, et cetera, Apple in its heyday, and the operating margins are comparable to those companies and have been that way for a long period of time. So in the case of Franco-Nevada, they turned a $2 million investment in a particular mine into something like $2 billion because it provided them with the optionality on the price of gold, and it provided them with an optionality in that the mine might actually possess more gold than they originally thought, which was the case. So it's just an incredible business characteristic of these royalty companies.
Right. If I understand you right, the thing that you like about the royalty companies versus the producers is you have access to, yeah, there we go. There's the slide you guys were talking about. With the royalty companies, you guys have access to the appreciation in the value of the asset that you want to own, but you're doing it in a very capital efficient way. Correct.
And it provides you with optionality on the price moving higher, and it prevents you from basically being hit with costs that potentially the cost of mining it becomes much more expensive because there's inflation in wages, et cetera. You don't have any of that. You're just getting a royalty stream. You're entitled to 10% of a particular mine. So you can, all of that cash that you receive from the royalty is really essentially free cash flow after taxes. And then you can buy back your shares, you can make more investments, et cetera. So for most of the royalty companies, the only way that you really lose over an extended period of time, if the price of gold declines on an annual basis more than the discount rate at which you're buying in. So let's say you bought in at a 12% discount, gold would actually have to decline by more than 12% per annum in order for you to take a loss over the life of your holding.
Got it. And we were talking about vehicles for gold. What about for Bitcoin? I know there are people who hold it, like, Chris was just holding up a USB stick. You can hold it there. There are basically vaults, virtual vaults. Or there are other vehicles where you can basically have like a Bitcoin ETF, something like that. What's your preferred method for holding Bitcoin?
So if you're a hardcore cryptocurrency holder, the belief is that you should have and control your own keys, both your private and public key. And typically you do it on some device like Chris has. That's kind of the most people are not there today. You're not going to find Mrs. Smithers who has that technical skill to do that, or it's going to take her some time before she figures out how to do that. So, if you believe in the legacy system here in the United States, it's not going to go away. They're not going to, steal your coins. The government's not going to come in and take them away from you. Then, an online company is appropriate. And then there's there's Grayscale, which is a trust, open-ended trust that you can buy, and you have an ownership stake in that trust, and they own the underlying coins, and hopefully they're keeping them safe. But in truth, if you really want to be the most secure, you put it on a portable ledger device similar to what Chris showed you, and that goes with you wherever you go, and you put it somewhere very safe.
In addition to owning Bitcoin and in owning a trust like Grayscale or one of the ETFs around that are not in the U.S. but in Canada and other places, you can also buy futures on the Chicago Mercantile Exchange and the Intercontinental Exchange. And both of those have seen pretty significant increases in volume as institutional investors have decided to label cryptocurrency and Bitcoin specifically as an investable asset.
Okay, got it. So I understand what you guys are saying. You're saying for somebody who's technologically savvy, the way Chris is holding Bitcoin is maybe the most secure way to do it. For others, you might hold it in a vault, something like that. Now, I know there's this sense that the blockchain ledger is unhackable, but there have been thefts in the past. And there's also the new advent of quantum computers. Do they make everything hackable at this point?
So, you're asking great questions. These are the most difficult questions that you have to, grapple with as a potential investor in Bitcoin. So really, to date, the Bitcoin blockchain has not been hacked. And the robustness of the blockchain itself makes it very unlikely that's going to be hacked. There has been blockchains that have been hacked, in fact, one very recently. But really, those that are very less than robust blockchains, and it's two computers speaking to each other, and you can hack into one computer, you can block through that. So there's something like 100,000 different nodes, full nodes protecting the blockchain, Bitcoin blockchain. And it's very unlikely that's going to be hacked in any time soon. With regard to quantum computing, there's a belief that quantum computing will have enough power to hack a private key address given just the public key address. And it's just through pure brute strength of computing power. The problem with that is that most of the public keys that it would, in theory, be able to hack are not revealed until the transaction is actually posted to the blockchain. So let's say you had 10 coins and you got rid of those 10 coins. Your public key is now available on the blockchain, but the computer can hack that, quote, your private key. But when they go back to the private key, they realize that you no longer have any Bitcoin there. If you had 10 coins, but you only sent out 3, now they could have access to the 7. It's estimated that maybe 25 to 30% are unsecure that way. In the advent of quantum computing, that maybe they could steal 25 to 30%. There's already designs to change the safety of that regarding the private key, public key, and the public address of that within the Bitcoin community. The second layer of security is the hashing power of the network itself. And that's done by the miners. And it's believed that quantum computers are actually going to be able to even keep up with it, or they don't have the capability to do the hashing issue. So they could never do a 51% attack where they could go in and rewrite the history of the blockchain itself and move coins around. So it seems that Satoshi Nakamoto, whoever that happened to be, when he wrote this, recognized the potential for additional computing power to hack it, and he gave the community itself a way to get around it and already to protect it from that today, if you know how to handle it right properly. So Chris's coins, as long as he hasn't done a partial transaction with what he has on that ledger, could never be hacked by a quantum computer.
I think it's also important to recognize that there have been hacks of trading organizations that owned coins in what we would, as stock and bond investors, think of as street name. So as opposed to putting your Bitcoin at Coinbase in a vault, your Bitcoin at Coinbase is just held in Coinbase's general accounts. So think back in 2008, if you own securities at Lehman Brothers, when Lehman Brothers went under, you, in essence, your securities, if they were in street name, then your securities were basically worthless. However, if you had those same securities in safekeeping, then those securities were still held by you. You were the eventual owner. So the same is true of Bitcoin. Bitcoin, like I can open an account at Coinbase. I can buy a Bitcoin. I can keep it on Coinbase's in my regular trading account. And it is, if somebody can hack into Coinbase, they can steal my coins. But if I, in that Coinbase account, I can put them into what's called savings, which means you take them offline and put them in cold storage, which you mentioned earlier. Then those Bitcoin are unhackable.
And probably everyone has heard the company Mt. Gox. Mt. Gox was the biggest hacking of a custodian. And back in the theft occurred from 2011 to 2014 when it was fully discovered. They stole about 850,000 coins, and those coins were lost. I think they got back 200,000 eventually, and they ultimately traced the person who did it. But it happened.
Okay.
So the moral to that story is put your Bitcoin either on a private ledger or in savings. Don't keep them in a trading account.
And the distinction is it was not the Bitcoin blockchain that was hacked. It was the custodian or the company that actually had the vulnerability.
Right. Understood. It wasn't a problem with Bitcoin. It was the place where people were storing it. Some good news here. We're getting some great questions from some of the people on the call. Tony Saxton, who's a Deep Knowledge Investing Board of Advisors member, with a great question here. He wants to know, why wouldn't countries ban Bitcoin and create their own digital currencies? And aren't some countries already doing that?
Sure, they will do. There's no question that you're going to see a digital US dollar at some point in the future. And it's not inconceivable to me that my grandchildren will not understand what a quarter is or a dime, or it becomes a collectible. So again, I would say that the trend, with minor exceptions, is not to basically ban it. It's actually to embrace it. So in the case of, as Chris mentioned, certain states here, you can pay your taxes, state taxes, with Bitcoin. Wyoming has passed 13 laws in the last couple of years to facilitate the development of Bitcoin and cryptocurrency, because they're hoping to do that. And if you look at the number of new businesses, even going through this pandemic, the number of new businesses open up in Wyoming is skyrocketing as a result of basically that development. So again, I would say that if I were running a country, I would allow it to flourish, and I would make sure that I could be able to track it and get my taxes from that. So if you think that the stock market is grossly overvalued, which I certainly do, the prospects of capital gains going forward, I would say, is pretty low for the next decade. Bitcoin and cryptocurrencies as an opportunity for revenue generate for various countries. So I would actually be in favor of embracing it. And that seems to be the trend. Now, that could reverse itself, but to date, there's no indication that globally countries are trying to basically squash it.
I love the fact that the argument you're making is one of self-interest. And I think we can reliably count on people to follow that as a guiding principle. Definitely a smart way to think about it. Another question that came in from another Deep Knowledge Investing Board of Advisors member, Kit MacArthur. He wanted to know if you guys have any concerns about the energy intensity of Bitcoin mining, and in addition, the energy intensity of tracking Bitcoin transactions. Essentially, there's a lot of coal and natural gas being burned to power those processors.
Yeah, so I mean, that's been a concern and a criticism from day one, really. And if you look at the power generation, I think on an annual basis, the Bitcoin network is consuming about as much power as the country of Colombia. The technology is improving, and the hashing rate and the strength of the network keeps going higher, and the consumption of energy is actually coming down, or it's not growing nearly to the extent that it was. But that kind of overstates the consumption of energy. So if you're moving your mining operation up to Quebec, where there's hydroelectric up there, they're producing the energy anyway, and that energy was actually being wasted. Now you bring up a mining operation up there, and suddenly you're using that. You're helping to subsidize the existing users of that electricity on that network. So my guess is that the carbon footprint and the energy consumption is actually pretty modest, something substantially less than the entire country of Colombia on an annual basis. And when I look at the existing infrastructure, so literally right before we got on this call, my wife came in and handed me mail. She handed me a solicitation for a credit card. They had to cut down a tree. They had to print this. They had to mail it to me, got here on a plane or truck, et cetera. The amount of energy consumption by the existing infrastructure is just enormous as well. So I'm not sure that Bitcoin in fact, I'm reasonably confident Bitcoin financial system is substantially less than the current infrastructure.
There's another statement too, and that is that I read recently that if you simply utilize the flared gas, the free flared gas in the US, it would be 8 to 10 times larger than the hashing power currently of Bitcoin, which is about 19 exahashes. So you would have enough to power the Bitcoin network 8 to 10 times more powerfully.
Right. So what Chris is talking about is that the drilling for shale out in the western, in the Delaware or the Permian Basin, and when you're drilling for the oil, the gas comes up, and the gas is basically just burnt away. So so that's going into the atmosphere. It's causing climate change, and nobody really wants that. The Bitcoin community is going out there with trailers and putting in their computers, and they're basically using that natural gas to mine Bitcoin. So a lot of the consumption that, quote, the Bitcoin community is using was going to be used anyway. So it's not really like they're adding to such a large footprint to the problem of climate change.
Okay.
One point that we talked about earlier, which I wanted to get back to just for a quick moment, is the main reason we're looking at gold and the main reason we're looking at Bitcoin is because of the excessive printing that is going on of dollars and other currencies around the US, around the world. And one of our charts has this massive expansion rate of dollars and the dollar market over the last 25 years. And we know exactly how many Bitcoin are going to be created. They're going to be 21 million Bitcoin. There are 18.5 million today. And so it's important to note that that's really, it's a scarcity thing similar to gold. Today, Bitcoin mining produces approximately 900 Bitcoin a day, which works out to be about a 1.95% inflation rate. It is unlike any other asset from that point of view.
Got it. And Steffi, just so you know, the slide that Chris is referring to is number 3. If you can just toss that up for a few seconds so people can see. Peter and Chris, we're down to our last 2 important questions here. Brian Cohn had a great follow-up to Tony's question. And actually, hold on, Steffi, can you, yeah, here it is. Brian wanted to know if the value of Bitcoin is vulnerable to competition from other existing or other up-and-coming cryptocurrencies. Basically, who's going to win this battle here?
So as of last night, there's something like 7,200 cryptocurrencies or initial coin offerings available for investors. And Bitcoin has a tremendous advantage for 2 reasons. One, it has first mover advantage, and its network is by far dominant in terms of hashing power and security. And then secondarily, they have a better monetary policy. So as Chris just pointed out, there's only going to be 21 million coins in existence, and that's not going to take place into the year 2140. And currently there's about 18.5 million coins outstanding. So you can see the inflation rate of Bitcoin is going to be very low. And that scarcity value makes it very unique. Most of the ICOs or cryptocurrencies that Bitcoin is, quote, competing against are really done by a handful of people. They said, hey, this is a potential to become wealthy. Why don't we control 80% of it? And why should I trust a handful of people? The same way I don't trust governments around the world from inflating the currency. I wouldn't necessarily trust four people in a room doing the same thing with the cryptocurrency. So I don't think the overwhelming, I know for a fact, the overwhelming majority of those cryptocurrencies or ICOs are not true competitors of Bitcoin. And it would be, if I was going to transmit any significant value across a decentralized network, I would want the most robust, secure network, and that is by far Bitcoin. So it's hard to see how Bitcoin is not going to be one of the ultimate survivors and big winners within this.
Gary, I just wanted to make sure that Peter mentioned something about indexation and why it's important to have inflation exposure, inflation beneficiary exposure in your portfolio. We've written tremendously about indexation, some of the problems with ETFs and indexation, and that's one of the slides. And Peter, would you just address that really fast? Sorry, Gary, I know we're coming up on a hard stop, but I think it's important.
Yes, in theory and in practice, there's nothing wrong with ETFs and investing in a basket of goods. And for a lot of people, it actually might make sense. The real problem is that it makes no distinction about valuation. So maybe buying in the S&P 500 made sense when the stocks are trading on average 10 times earnings, but then money flows into it. And by design and legality, the sponsors of those ETFs have to buy the same name. And they buy them whether they're trading at 10 times earnings or 35 times earnings. At 35 times earnings, there's a good chance that you're never going to make any money. And that's the situation that we're faced with today. There's no regard to valuation. And if you overpay for a great company, you're going to end up with a bad result. And that's really what's happening within the ETF industry. And we're trying to stay as far away from that. And one of the things that provides uniqueness is exposure to Bitcoin and cryptocurrency. And the royalty companies, which are not included in the ETFs, also provide you that. So there's actually the real inflation that has occurred since really the financial crisis has really been in financial assets and in the goods and services that you truly desire: healthcare, education, financial assets. Those things are inflating at a very high rate, and it's principally because of the easy money policies of governments around the world.
Got it. Okay, last question here. You guys have what I consider to be a very interesting point of view regarding asset allocation. So I come from the public equity world, where if you have a great idea, you overweight it. And in my end of the world, if we have something that's our best idea, it's going to be our biggest position. I know, having spoken with both of you privately, what you advocated is to say that Bitcoin is such a fantastic idea that you should only allocate a small percentage of your portfolio to it. It's the exact opposite of what people in the equity world do. I want you to take a minute to talk about it, because it's a really interesting approach, and it's different from the way people like me think.
So let me just state, we're in accord exactly with your thinking. We manage equity, and our biggest position is a 20+% position in people's portfolios. So concentration does not unnerve us. There we can assess the financial risk, we can assess the cash flow potential, et cetera, and we can discount it back to some reasonable rate, and we think we're getting a great deal on the company that happens to be our largest position. In the case of Bitcoin, you don't have that, and you don't need that. In terms of what I mentioned earlier, if it becomes the global store of value, and it equals all of the other nominal stores of value, i.e. it's considered to be better than dollars, yens, liras, et cetera, Turkish liras, et cetera, T-bills, and go around the world and do that, the number is absolutely staggering. And as a result of that, you have this asymmetric upside potential. So if in success mode, a 50 basis point position could ultimately become your largest position in your portfolio. And if you're wrong, it goes down and loses 50% in year one, and then 100% after the year two. You lose 50 basis points in 2 years. It's kind of a rounding error in your performance. So that was really the thinking behind it. And there's certainly things, as much as we know about Bitcoin, and it's probably, not to brag or anything, it's probably more than 99% of very educated people know about it. It's just because not what they're paying attention to. We don't know everything, and we can't see everything. So we said, okay, in that scenario, let's just make it a small position in portfolios. And if we're right, and so far it's up 25, 30% since we initially got in, and we haven't trimmed it back, but we never really risked more than 50 basis points.
Got it. I understand. Your point is that you have such a great asymmetrical risk reward here that you don't need to make it huge, and you can protect your downside. Guys, thank you so much for your time today. Everyone, this is Chris Bell and Peter Doyle from Horizon Kinetics. For anyone who's listening to this, who thinks that this is an interesting topic and you want to know more, or want maybe some help with specific investment vehicles on this, let me know. I will put you in touch with Chris Bell at Horizon Kinetics, and they'd be happy to talk to you about this anytime. Thanks so much, and everyone feel free to disconnect.